The stock market just dropped 20% and your investment portfolio is bleeding red. Everyone is panicking, the financial news is screaming recession, and your friends and family are telling you to sell your investments before things get worse. But here's what no one is telling you. The investors who actually build real wealth aren't the ones who dodge market crashes. They are the ones that understand that these moments are actually hidden opportunities that the average investor completely miss. Guys, a market downturn is where people get rich. So today I'm going to show you exactly why market downturns might be the best thing to happen to your long-term wealth if you know what to do. What's up, everybody? I'm Rashida and I'm your guide to smart money moves. I started my own wealth building journey at the age of 17. I've grown that portfolio to 7 figures, and I did this all on a police officer salary. So I'm on a mission to show you exactly how you can get there too. So let's go. Look, I know that market crashes are scary. I have lived through the dot-com bubble. I have lived through the 2008 financial crisis, the 2020 pandemic crash, and now this latest downturn. And each time I saw people around me panic sell at the bottom, locking in their losses forever. But the wealthy, they are quietly buying more. So today we are going to get into why it is so important to stay invested during a market downturn. And so in the next few minutes, I'm going to show you 3 critical things: why market downturns are actually wealth building opportunities, how to use dollar cost averaging to turn market volatility into your greatest advantage, and the shocking math behind why staying invested during tough times is the single most important factor to building wealth. Okay, so let's start with some perspective. Since the year 1928, the stock market has actually experienced 27 corrections of 10% or more. That is one every 3.5 years. And so that means it happens every 3.5 years. This isn't some rare disaster that you're experiencing right now. It is a completely normal part of how markets work. But here's what's fascinating. Despite these regular downturns, the S&P 500 has still delivered annual average returns of around 10% over the long term. That means that $10,000 invested in 1980 would be worth over $760,000 today, despite Black Monday, the dot-com crash, the 2008 financial crisis, and everything else that we have gone through. And now I want you to think about this for a second. The stock market has recovered from every single crash in history. Every single one. And the market just doesn't recover. It continues to reach new heights. And so here's what I've learned after decades of investing. Market downturns and crashes are not the exception. They are actually the rule, okay? That pain that some of you are experiencing right now is literally the price of admission for the incredible returns that the stock market delivers over time. If you want the reward, you have to be willing to go through those storms. The biggest danger to your wealth is not market volatility. It is your emotional reaction to it. And so let me show you what I mean. But before we do, please take a second, see if you have subscribed to the channel. And if you haven't, please consider hitting the subscribe button. I come here every single week to help you better understand this world of money, investing, and more importantly, how you can turn your income into real wealth. All right, let's get back to the video. This is something that is very critical to understand. Our human brains have evolved to protect us from danger. And so when we see our portfolio dropping 20%, our brain treats this like a physical threat. That's why when you open your investments and you see that they are down and down substantially, you actually have a physical, visceral reaction. You might get a pit in your stomach. You might get angry at someone who you think is to blame. These are all emotional responses to that. That's because our fight or flight response is literally kicking in, and all we want to do is escape that pain. And this is why so many people make the devastating mistake of selling their investments during a market downturn. They are not making a rational financial decision. They are responding to a psychological threat. But here is some data that changed everything for me. A study by JP Morgan showed that if you had invested in the S&P 500 from the year 2000 to the year 2020 and stayed fully invested, your annual return would have been 6.1% per year. But if you missed just the 10 best days in the market during that 20 years, your return would drop to 2.4% per year. And the craziest part about this is that those best days happened within 2 weeks of the worst days. That means when things looked the darkest, the biggest upward moves are often right around the corner. This is critical to understand. It is so important. And nobody, not even the professionals, can predict exactly when those days will happen. And I have seen this firsthand. During the 2020 pandemic crash, the market dropped 34% in just 23 days. That was the fastest market downturn in history. Everyone was panicking. But then what happened? All of those losses were fully recovered in just 5 months. And so those people that sold at the bottom missed the strongest bull market in recent memory. And so I know what a lot of you guys are thinking. If time in the market doesn't work, what does work? And so this is where a strategy called dollar cost averaging is going to come in. This right here might be one of the most powerful wealth building strategies, and it doesn't require you to be some financial genius. All dollar cost averaging actually means is that you are investing a fixed amount of money at regular intervals regardless of what the market is doing. So all that means is that if you like to invest $100 every week into your investments, you continue to do that no matter what. The market is crashing, you're still putting in your same $100 every week. And this is very important to understand because what this is allowing you to do, when prices are high, you are buying fewer shares of that thing. And when prices are low during a market downturn, you are buying more shares of that thing. And so let me show you how this works with actual numbers. So let's say you invest $500 every single month into your favorite index fund. So when the market is high and shares cost you $100 per share, you're going to get 5 shares with that $500. But in a market downturn, those shares drop to $80 per share. And so that same $500 that you put in month after month is now going to buy you 6.25 shares of that index fund. And so you see what happened there? You're putting in that same $500, but you're getting more of that company ownership in return. And then if prices fall to $60 per share, you're going to get 8.33 shares of that fund. So that means during the market downturns, you are automatically buying more of those shares at discounted prices. It's like walking into your favorite store and finding everything on sale. You don't run away when things go on sale. You buy more. I have been doing this for decades at this point, during bull markets and bear markets. That's the same as saying when the market is up or when the market is down. And so through that experience, this is what I've discovered. The times when it felt the scariest to invest, when the news was terrible and everyone was panicking, those turned out to be the best buying opportunities of my life. And the beauty of dollar cost averaging is that it takes all of the emotions out of the equation. You are not trying to guess market tops and bottoms. You are simply committing to a regular investment plan, and you're going to let time work its magic for you. And so that brings us to the true secret to building real wealth, and that is compound interest. So bring it in close because I need you to pay close attention to this one. Albert Einstein famously called compound interest the eighth wonder of the world, and for good reason. Compound interest means that your money makes money, and then that money makes more money, and it just begins to snowball and build on itself. And over time, this is going to create an exponential curve that can transform modest investments into substantial wealth. Guys, as people in the middle class who are looking to play this investment game, this is where the magic happens. You have to put time into the market to allow this benefit to manifest itself. Do you understand what I'm trying to tell you? And so let me show you why this matters so much during a market downturn. So let's say you invest $10,000 into the stock market, and that $10,000 grows at an average annual rate of 10% per year. After 20 years, that same $10,000 has become $67,000. But if you panic during a market crash and you miss just 1% of that return and you're getting 9% instead of 10, your $10,000 has ended up being $56,000. And so just that 1% difference cost you 11 grand. And that may not seem like a big deal to you, but if you make this same mistake over a 30 or 40 year timeline, the difference becomes staggering. So let's look at this same example stretched out. At 10% for 40 years, your $10,000 has grown to over $450,000. And at 9%, that $10,000 grows to $275,000. That is a $175,000 difference from that 1 percentage point. And this is why staying invested is so critical, you guys. You have to stay invested no matter what the short-term picture looks like. Because every time that you try to sell your investments during a crash and try to time your way back in, you are actually interrupting that compound interest miracle. You are literally resetting the clock on what could be exponential growth. I have seen so many people focus on avoiding short-term pain in a market, but they don't realize at the time that they're doing it at the expense of long-term gain. They sell during downturns thinking that they can buy their way back in when things feel safer. But by the time things feel safe again, the market has already recovered a significant portion of those losses. So I want you to remember this. Compound interest requires time and consistency. Market crashes are temporary, okay? But the damage of interrupting your compound growth, that is permanent. So what exactly should you do during a market downturn like the one we're experiencing now? And so let me share with you guys the exact strategy that I've used during multiple market crashes to not just survive, but thrive. The first rule that I live by during a market downturn is to stop looking at your portfolio every day. When the markets are doing what they're doing now, I don't look at my investments at all. And so that removes that emotional, visceral response to seeing your money loss is very important, because when a market is dropping, checking your balance constantly is only going to trigger the fight or flight emotions that we talked about. That's all it's going to do. Looking at losses, it's not going to help you, and it means very little in the long term and grand scheme of things. So just don't even look. I check my investments maybe once a month, and during volatile times, I check it maybe once a quarter. Just enough to stay informed, but not so much where I'm going to make some sort of emotional decisions based on what I'm looking at. The second thing you want to do is reframe how you even think about market downturns. That's the whole point of me making this video, because to be honest, when markets downturn like this, I honestly see it as an opportunity to buy things cheap. This is where the money is made, guys, because when the market rebounds and goes on to new heights, you bought everything at such a bargain price, 20% off, 30% off, depending on what you're in. So instead of seeing red numbers as losses, see them as shares on sale. This is where the money is made, I'm telling you. And if you're planning to hold for decades anyway, the only thing that matters is how many shares you own, not how much they are worth today. And the third recommendation that I have for you is to increase your regular investment amounts during big downturns. This is when dollar cost averaging can become even more powerful. You are buying more shares at a discounted price. I have personally increased my monthly investments during every major market crash, and those investments have consistently outperformed my regular ones over time. And the fourth thing you must do, and this is through all time, times is to maintain a proper emergency fund. Because if you've got your 3 to 6 months of expenses in cash sitting in a high yield savings account, that is going to give you financial security to remain invested during market turbulence. Because if you need to access money during a downturn, you can use your emergency fund instead of selling investments at a loss. And the fifth thing on this list is to remember your time horizon. If you are investing right now for retirement that is 10, 20, 30 years away, these short-term market movements simply don't matter. In the grand scheme of things, they are a blip on the radar because the stock market has never lost money over a 20-year period in its history. Not once. And the last thing that you may want to consider doing is to work with a financial advisor if market volatility literally keeps you up at night, because sometimes having that objective third party can really help you to stay disciplined when your emotions are running high. And speaking with a professional, it can help you better understand the bigger picture when it comes to investing. All right, look, I get it. Seeing your portfolio drop 20%, it isn't fun for anyone. But what separates those who build long-term lasting wealth from those who don't isn't avoiding market crashes. It's how they respond to them. And as the great Warren Buffett famously said, be fearful when others are greedy and be greedy when others are fearful. This simple but powerful advice has helped him become one of the most successful investors of all time. During the 2008 financial crisis, when everyone was panicking, Buffett was buying, including a $5 billion investment in Bank of America that eventually earned him over $12 billion. And so that right there is the mindset that you have to adopt if you want to go on to build wealth, because every single market downturn in history has led to new highs, every single one. And so if you can train yourself to see market downturns not as disasters, but as opportunities, chances to buy more shares at lower prices, then you'll be thinking like the Warren Buffetts of the world and the truly wealthy. Remember, it is not market timing that builds wealth. It's consistent investing, patience, and allowing compound interest to work his magic. That is what is going to help you create financial freedom. And if you found this perspective helpful, please do me a huge favor, share this video with 3 friends. It really helps out the channel, and you never know who you could help with information like this. You could help somebody turn their financial life around. All right, you guys, it's been a pleasure. Thank you so much for being here. I'll see you in the next one. Again, I'm Rashida, and I'm out.